Welcome back to Morning Markets on Thursday the 5th of January. A positive day for stock markets yesterday, with markets led by European markets, encouraged by easing inflation pressures across Germany and France, and therefore easing interest rate hike expectations moving forward. Bond yields also moved lower, which was positive for bond returns on the day. In terms of inflation, inflation was a hugely important topic through the course of 2022. The good news is inflation appears to be easing in a number of very important areas. In France, the annual rate of inflation cooled from 6.2% to 5.9%. This was interesting, as the market was expecting a level closer to 6.5%. If we look under the bonnet, we can see that the cost of manufactured goods continued to be one of the key inputs into inflation, along with service costs, so restaurant costs, bar costs and so on. Whilst energy was still a significant component, it was starting to ease. In terms of Germany, we also saw this week inflation moderate from 11.3% towards levels of 9.6%. So in summary, there's more work to be done by the European Central Bank to bring inflation towards those 2 to 3% targets, but an encouraging trend is starting to form in terms of moderating inflationary pressures. In terms of the Federal Reserve, we also had the minutes which were released yesterday from the December meeting. For reference, in December, the Federal Reserve raised interest rates by 0.5% to a level of 4.5%. To some market participants, that increase came as a bit of a surprise. It was softer than what they were expecting. We've had a series of 0.75% increases from the Federal Reserve in their more recent meetings. The decision in December to take a softer approach followed evidence that inflation appears to have peaked, with easing pressure in the energy markets, but also in terms of the cost of physical goods in the US at this point in time. In the minutes which they released last evening, Fed officials made clear that more interest rates were required in order to bring inflation towards their 2 to 3% target. According to official estimates, the interest rate expectations from the Federal Reserve sit between 5 and 5.25%, so suggesting that there could be another 0.75% worth of interest rate hikes to come through the course of this year. No members at the Federal Reserve are currently expecting interest rate cuts to come through this year, despite what the market is currently suggesting. In terms of the economic outlook, the Federal Reserve recognised that labour markets are very strong at this point. We're talking about unemployment levels in the US at 3.7%, which is putting upward pressure on wages, but it's also giving consumers a lot of spending power to get out there and spend, which in itself is an inflationary pressure. They expect unemployment is going to rise by around 0.9% through the course of this year, so still taken to a low level, but a level of around 4.6%. In terms of inflation, using the Federal Reserve's preferred measure, which is the Personal Consumption Expenditure Measure, or the PCE, they're expecting inflation to move from current levels of 4.7% to levels of around 3.5% by the end of this year, and then levels of closer to 2.5% by the end of next year. In other words, in line with their target. So inflation expected to move towards target over the next 24 months. Thank you very much for watching. We look forward to bringing you up to date tomorrow here on Morning Markets.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.